Hi folks, Chuck Gibson from Financial Perspectives in San Ramon, California with June 2017's Charts on the Move. Since we just tied a bow around the second quarter, this month's video will be spent reviewing where we stand across many investable markets. I have lots of charts, so let's get started. The first chart is a year-to-date relative performance across a vast number of tradable assets. As you can see, so far this year hogs have been the big winner, racking up a 35% gain. Keep in mind, these aren't just any old hogs, but we're talking about lean hogs. Going down the list, some other notable winners include wheat, which I wrote about in a blog post, is up now more than 20%. The Nasdaq 100, our largest holding, is up a bit more than 16%. The German DAX, gold, and the S&P 500 were all up 8%. U.S. small cap stocks have lagged the overall market as they are up just slightly under 4%. The 30-year bond has managed a 2% return, while the 5-year note has squeaked out a fractionally positive return, and the 2-year note is actually down for the year. In spite of all the chatter and worries about inflation, we continue to have just the opposite, as most of the year's losers were from the commodity sector, including coffee, soybeans, ethanol, oil, natural gas, orange juice, and the big loser, sugar. My next chart is a Q2 look at the U.S. stock indexes. As you can see, the NYSE, S&P 500, small caps, and the industrials were all within a tight 1% range, rising between 2.5% and 3.5%. The Nasdaq continued its dominance as it was the big winner, gaining almost a full percentage point more. I do want to point out, though, that the Nasdaq was outperforming on a much bigger scale, but since the second week in June, it has struggled, actually declining while the other indexes were narrowly higher. Looking at Q2 U.S. sector performance, the big winners were healthcare, financials, and industrials, while energy got smacked around big time, falling more than 9%. Moving over to my regular longer-term view charts, we can see the S&P 500 is clearly still in an uptrend, as prices above the blue dashed rising support and the red rising 200-day moving average. I want to point out we have formed an overbought divergent high on RSI momentum. These occur frequently and are a sign of a very strong uptrend. So while that is good, they always, whether it be sooner or later, mark the need for a correction. That correction can be through time or through price. A good example on the same chart was the multiple overbought divergent high conditions that occurred during this 2013 through 2015 rise. It eventually played out in this correction here. Looking back on a longer-term chart, it seems so minor and insignificant, but it wasn't when we were going through it. Remember? I mention this only because when the next one occurs, and it will occur, it's good to remember this backing and filling is what the market does, and there's no need to panic. The next chart is that of the U.S. microcap stocks. As you can see, it recently broke out of this beautiful cup and handle pattern to the upside. There's absolutely nothing bearish about this chart. In fact, this is a huge feather in the cap of the bulls. If the smallest of the small, the most risky stocks, are above a rising 200-day moving average and breaking out to all-time highs, this gives us confidence investors are still strong buyers of stocks. There's no other way to interpret this. At least, as of now, you can ignore all those stock market crash newsletter writers who are trying to play on your fears and get you to subscribe. Save your money, go out, and enjoy life. Don't fear it. Looking at a very long 15-year plus look at European stocks, the message couldn't be any clearer. Prices above a blue dashed uptrend support line and the rising 200-day moving average. To cap it off, it is broken out to all-time highs. I defy anyone to point out anything in this chart that indicates stocks are struggling and you shouldn't continue to be invested. Q2 closed out a very consistently positive message for the global stock markets. Unfortunately, that same thing cannot be said for commodities, as you can see in my next chart. The CRB index, which is a basket of 28 different commodities, has been in a very long-term downtrend, but has recently, as of last year, begun to look as if that trend were going to end. But right after this slight bounce, the index chopped sideways for more than a year and then just recently broke to the downside. Because this index price is 25% based on oil and oil-related products, it does mirror the movement in oil. And speaking of oil, after bottoming on a divergent oversold low, price rallied for 6 months, but has since stalled and been stuck in the channel. With hugely negative fundamentals, a worldwide glut with minimally increasing demand, and in spite of OPEC's attempts to bolster price, it looks as if it's going to be lower prices from here. A retest of the 2016 lows would not be out of the question. I have to be real careful interpreting charts, and you need to take what I say about investments whose price is controlled by a few with a grain of salt. Charts only work for truly liquid markets, not those that can be moved by news in a few big players. News always trumps the charts. The next chart of gold had what now looks like nothing more than a very nice counter-trend rally that started in 2016, raising the hopes of precious metal evangelists everywhere. But after hitting the red overhead resistance zone, it has since resumed its downtrend. Like oil, price looks lower from here. While gold is not as bad as oil, it's a market that is relatively small and dominated by a few big players. As such, investors need to take this into account in their investment management plans when committing investment capital. My next chart of the US dollar has been nothing short of exasperating. I have to admit, I was sure, based on what the charts were telling, that the US dollar was in a long-term uptrend and this 2-year plus long consolidation would eventually resolve to the upside. Well, that's exactly what it did. And then it promptly reversed back. You can see in the breakout was followed by an immediate retest of that level and then another small push higher. This is exactly what you want to see happen after a breakout, as it acts as confirmation. But then the story turns ugly as it retests the breakout level twice more and eventually gaps back into the prior consolidation zone. This, folks, is a great example of a false breakout. So, for now, this chart is broken and the bears are in charge. My bullish US dollar thesis has been put on hold, at least for now. So, until we finally truly break out of this box, either to the upside or down, I am officially neutral on the direction of the dollar and the ramifications to its effect on other investments. A look at the 30-year US Treasury found price eventually found support in January of this year, right at the exact same prior low formed back in the first half of 2015. Bonds have since rallied and are sitting on their falling 200-day moving average. For now, and until it can take back the bullish momentum zone, this is viewed as nothing more than a normal, short-term counter-trend bounce, and the higher probability would be to expect lower prices, that's higher yields, ahead. But keep in mind, higher yields may not mean across all maturities. I wanted to point out something interesting that is happening, which is illustrated in my next chart of bond yields. As you can see for the quarter, all bond yields ended lower except for the 3-month Treasury. What this is illustrating is a flattening yield curve. The short end is rising while the long end is falling. Why this is important is because historically, most recessions have begun after the yield curve has flattened and then inverted. A healthy growing economy would reflect a yield curve that would be sloped steeply higher. The bigger the slope, the healthier the economy. Well, at least in theory. While I am skeptical of the potential for a recession at this point, it is something to watch. I believe this flattening is actually caused not by investors, but rather government central banks, which are on a completely different mission and agenda to manipulate their currencies and yields in this dog-eat-dog economic fight for supremacy. To wrap this up, it should be pretty clear. Not much has changed from last month or even last quarter. Globally, across the developed world, bond yields are either normalizing or on their upswing, which is putting a strain on bond prices. Most commodities are weak. There are a few exceptions like hogs, while stocks worldwide continues to march higher. With only one real home for capital, the rise in stocks has created a very frothy market and looks as if we're setting up for a pullback. Whether it plays out, only time will tell. But let's take a look at my final chart, a shorter-term daily view of the S&P 500, which hopefully illustrates my near-term concern and is representative of what I see across most stock market indexes. As you can see, we are extended well above the 200-day moving average. Price doesn't like to get too far away from it, and when it does, it eventually corrects through time or price, as it did here and here. Next, we have formed negative RSI momentum divergence. This is a warning that price has gotten ahead of itself and is in need of a rest. Unfortunately, it doesn't tell us when a correction will occur or even how much it will decline. Finally, price has created a well-formed 5-touch rising wedge, outlined with the red dashed lines. A break below the bottom support line, which would also coincide with a confirmed break of this blue horizontal support, has a downside target at T1 here, some 7 to 8% below. If this level did not hold, the next natural support level is down at 2180 here. With the summer market doldrums officially upon us and the big money is on vacation in the Hamptons, this is ideal from a timing standpoint. But because this market has demonstrated such incredible resilience, it would not surprise me if none of my concerns were to materialize. The bottom line is any pullback that we are to occur here in the short term, regardless of its size, should be viewed as nothing more than a normal pullback within a longer term uptrend. Well, that's it. And until next month, as always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with June 2017's Charts on the Move.